Now we're excited to move into the discussion panel. Moderating the conversation is Mike Lin, investor, engineer, serial entrepreneur with over 2 decades of experience across climate tech, venture capital, and sustainable innovation. Mike is the co-founder of Dangerous Ventures, an early-stage fund backing resilient, planet-positive startups, and a lecturer at the Stanford Doerr School of Sustainability. From founding a renewable energy company that now powers over 12 million people to advising everyone from Apple to Al Gore, Mike brings a powerful blend of technical depth and mission-driven entrepreneurship to the conversation. Joining Mike on stage are Sophie Purdom, who we just heard from, Brock Mansfield of Ameliorate Partners, and Kunal Doshi of Accelerate Investment Group. Please join me in welcoming Mike and the panel.
Thank you so much. Thank you, Mandy. Thank you, everyone, for joining us. Before we get started, I was just wondering if I could get a quick show of hands of the audience here. So I'm curious, how many in the audience are students? So we have a small number of students, great. How many are alumni? A good number of alumni, great.
Wow.
And then I'm curious, how many are Stanford faculty and staff? Great, a good number as well. And for the rest of you then, how many are in the industry in kind of climate or sustainability? Wonderful, a lot of folks from the industry. And then capital allocators. Great, a lot of investors. And perhaps within industry, how many are entrepreneurs in the journey? Great. So I'm delighted to introduce this panel. I'll begin with Sophie. I'm curious if you could just kind of briefly cover your background, and we'll go down the list. Yeah.
You guys just heard from me for way too long. So Sophie, I write that newsletter that we just harped on about, and I didn't mention much about this, but I also invest in those solutions through a new fund, which is called Planeteer Capital. And Planeteer is right-sized to be that pre-seed and that seed lead check into climate founders really across the hardware to software spectrum. So we're a bit of a startup ourselves as well, and you will hear more about us in a month or so.
Thanks, Sophie. I'm Kunal, a partner at Accelerate Investment Group. We basically focus across the capital stack, from venture, growth, buyouts, with the intent of focusing on private, climate, and energy transition. We've heavily focused more on fund investments, given the preferences for our clients. But we do co-investments, directs, primaries, and secondaries.
Wonderful. Brock Mansfield, managing partner at Ameliorate Partners. We are an early stage fund, currently investing out of our fund 3. We like to be first checks in. So we're at the very, very early stage here. We do that. When we think about why we invest and what we choose, we're very philosophically driven. I think I mentioned this last year, but I wanted to repeat it here because we think it's even more important now, which is for so long, we've operated our economy around this idea that there's this abundance wherever we need it, and we can create waste without consequence. And so our entire philosophy and our entire portfolio is built around things that are better, cheaper, faster, that are better for the environment as well than current solutions. So that's our positioning.
Fantastic. So I'd love to begin with Brock. So we're here at Stanford, where there's a lot of amazing research happening in the labs. And Brock is also a member of the teaching team in Stanford Climate Ventures, where there's a lot of deep tech companies and first of its kind plants being produced. And while capital is still flowing into climate tech, many of these companies in deep tech, building folk, productions, are hitting a wall. And I'm wondering if you could speak to if you think that this is temporary, or if this is something that's kind of structural that's emerging, and what might these, upstarts and these projects consider as they're getting going?
Well, first I'd call it Sophie. I thought that presentation was fantastic, by the way, and I think that one of the things that I really took from that we're seeing a lot of is this kind of convergence between what I would say is this climate tech fervor and then the realities of the venture market and the realities of the economy. And so when you say things are hitting the wall, the elephant in the room obviously is what's going on in the administration. I'm going to skip over that because there's lots of different ways to interpret that with what's going on right now. But what we're seeing a ton of is companies that from the beginning maybe have struggled with business model or their markets haven't evolved. And so what you're seeing, and particularly in the venture side from our perspective, is just this consolidation where people are, it's the shakeout. venture does this every so often. So when you hear, this idea of like, oh my God, the sky's falling, things are hitting the wall, we see this as, if we're on Fund 3, we've been doing this for a long, long time. This to us feels like a lot of really well-meaning, well-intentioned innovation, not having a market develop, not being able to get to where it needs to be an ongoing part of our economy.
Mm-hmm. And let's spill the tea a bit. So let's talk about techno-economic analysis. And I'm just kind of curious, this is kind of for anyone here, how important is that then to really ensure that the best companies can communicate what they're doing and get funded?
That was very clever. Spill the tea as in the TEA?
Yeah.
That took me a second. Love a good pun. That was nerdy. I guess I'm talking now, so I should probably continue with my perspective on spilling the tea. Climate tech companies are often trying to do many things at once, right? They're bringing a new tech to market. They're sometimes also building literally a new market, and just doing everything that a strong business has to do simultaneously. There's founder risk, there's geopolitical risk, there's funky market level risk, there's all sorts of stuff going on. For the founders that we're excited about backing, you can't mess around with the TEA. If that doesn't work, and then honestly, I guess I'm trying to beat around the bush a little bit here, but if the TEA doesn't work, then venture probably isn't for you, at least our style of venture. I think that fits more into the science breakthroughs, kind of categorical, catalytic styles of funding, of which there's some sources of that out there, but frankly, those are a bit few and far between. I could also be completely wrong, right? Maybe that actually is the best source of venture, of taking giant risks, and then when it works, you've built a completely new solution, you've owned the market, and you can defend your way into that for a long time. So I'm willing to have pushback on that, but we tend to stick with things where the science is sound, there's some engineering risk, but there's a lot of clever deployment that has to go on, that folks are being clever about how do you capitalize through those stages to scale, and then there's immediate kind of commercialization all the way through. So I like businesses that go after a niche, that then kind of penetrate that and go after the adjacent markets, and they defensively scale their way into these commodity markets, which is frankly why climate's interesting, right? These are huge TAMs. But that's my personal bias. That's my tea on the tea.
Look, Sophie, I think that makes complete sense. I think from Clean Tech 1.0, we realized that venture firms can take technology risk, but not science risk, right? I think that is a differentiating factor. I would even argue, to Brock's point, given the cyclical nature of venture capital, we're at a phase right now where growth at all costs is not possible for investment firms at the moment, and so they are looking for a balance between growth and profitability, because in uncertain markets, cash is king. But that being said, there's still about $80 billion of dry powder out there, which is uninvested capital. And that capital needs to go somewhere. So it's not like there's a lack of capital available for venture backed startups. I think the challenge is the bar's been raised. And so the companies that probably would have made it through in 2021 or 2020 will probably not make the cut anymore.
Yeah, I may touch on two things, I think, to exactly your point. So we have 32 active companies in our portfolio right now. We have had 20 of them raise up rounds in the last 18 months. We have had 4 raise nearly $200 million in Q1. We have another 4 that are about to raise $50 million. We think, give or take $40 to $50 million. They're going to close in Q2. If you have the right model, there's capital out there. And I think we'll get a little bit later in this panel about other sources of capital that you can tap into. But from what we're seeing and talking with some of our co-investors and syndicate partners, capital, if you have the right model, you have the right idea, you're in the right place, that's not the issue. On the TEA side of things, I'm not going to use this is, some people know this is a little bit of a soapbox that I've been on, but I think there's actually a really fascinating conversation happening on campus right now, and I think happening on a lot of campuses around TEA. And that is, if you step back from this, and Sophie, again, you alluded to this in your presentation, there are some incredible innovations happening around the globe right now in sectors, in climate sectors, that are just kicking the tail of American innovation. Mm-hmm. And one of the things that we see at Stanford, we teach it, so we're working on this as well at Stanford Climate Ventures, is this idea of you should be thinking about, if you're going to be a venture-backed founder, be thinking about it's sort of the Wayne Gretzky thing, where's the puck going to be? And really specifically, what's the competitive TEA you need to hit? Not the TEA today, not the TEA that you think your innovation can do today or could get you, but where does it need to be in order to get this funding? Because we're seeing a fair amount of innovation that's coming out that's like, hey, fantastic, I'm able to capture nitrogen at $8 a kilogram. Well, the global market's $1 a kilogram. Guess what? You're going nowhere. It's not going to happen. You might get your first round funding. You might get second round funding because people are hopeful. But at the end of the day, if you can't make it down that slope, you just simply are going to have a non-competitive company. You're going to hit the wall, and I think that's what we're seeing with a fair number of things here.
Mm-hmm.
The benchmarks are changing, right? And so you've got to be well out ahead of, does the Series A demand that you're hitting the $1 a kilogram versus before, was that something that happened at like the Series B benchmark? So I think the benchmarks are compressing as folks are willing to take like less and less risk. But the thing that I think I want to say out loud is the like green premium aspect of expanding out that compression. If we're sticking with that metaphor, like the green premium aspect, that's dead. And there goes, much of the willingness to pay for, maybe it's $2 a kilogram in this example, or $4 a kilogram with the green premium. But when that evaporates, then you're back to just straight up market.
Yep.
And so, in my opinion, that's much of where that dissipation of the willingness to back something at a non-market kind of premium goes away, and therefore immediately, well, not immediately, because we're not an efficient market player, but then pretty quickly, the next round of funding, is holding you to a different benchmark.
And even, I think even more to the point, somewhere else in the world is figuring out how to do it at 25 cents a kilogram. Like that's right, so it's like, where do you need to be in spending more time up front? If there's one thing for any of the founders that are here, spend more time up front on discovery, spend more time really understanding where your market's going to be in 5 to 7 years and innovate to that. That would be my soapbox.
Absolutely. And so these topics are very much interwoven. Being an entrepreneur is everything, everywhere, all at once. Bring it back to the kind of the capital raising and the capital stack. Sophie, given all the great CTVC data and your insights, how might you advise founders to start kind of really think about the capital stack now as it stands, especially if they do have something that may take a little while for them to bring to market and commercialize?
I don't think anyone should start a business and plan to run that for, like, we don't have a perfect crystal ball, obviously, like, into where the market goes, but you shouldn't start a business to arbitrage, like, a momentary high willingness to pay from funds, to accelerate your fundraising journey. I think you should be building for a reality that you think would average out over, like, a 10-year time period. Mm-hmm. And so, I think I said, honestly, much of it in the presentation, but like clever leverage of those different aspects of the capital stack, which means that you're bolstering your venture dollars with grant dollars, you're bolstering it with funky joint venture types of partnerships, you're thinking about what does the exit outcome actually look like, which is scary when you're still on a piece of paper, but we have the data, right? You look at it, the truth is that lots of these outcomes are M&As, right? Is that interesting to you to build for $200 million outcome versus a $2 billion outcome? What partners do you need along the way to change that trajectory? Anywho, when we're that like first money in, we're looking for, are folks insanely commercial and are they clever about thinking about their capitalization with the fundamentals of like, does the tech work? Is there demand for it from the market? And we think that those two pieces are pretty good indicators of, are they going to be magnetic to pull in best-in-class talent, to weather storms and volatility, to just frankly be pretty like gritty. So with that, I think you can go a pretty long way. And who knows? I mean, you open you read the news, or maybe you don't every morning these days, and it's completely different, right? So folks that were directly impacted by tariff things, that's a complete whiplash. And like the clever founders are the ones that can like take a beat and think about, have they been managing their inventory in a resilient fashion so that when stuff whiplashes, do they have the working capital to kind of bridge all of that, but still be ready to kind of like hyperscale out?
Fantastic. And Brock, earlier you mentioned your portfolio companies, many of whom are going on to raise subsequent rounds. I'd love to hear if there's any maybe case studies. You could speak in broad terms or even aggregate, but what are some strategies that are working? What are the intrinsic qualities of these businesses? So for the entrepreneurs out there who are thinking about starting businesses, what sorts of attributes might they want to consider making sure that they have, or if they're already going, how do they adapt? And Kunal, for you to follow up as well, if there's any portfolio companies or even the managers that you back, the funds, what are they looking for? Because I think grounding some of these abstract concepts into concrete examples would be helpful.
Sure. Please go ahead.
One of the sectors where we spend a lot of time and have a fairly substantial portfolio is waste to value plays. And from a funding standpoint, obviously started with traditional venture behind it. But I have two specific examples I can give you where we've seen corporate step in with very, very substantial backing, not just on the financial side, but from a feedstock standpoint as well, which is super important. So we have one company called Tidal Vision. Tidal Vision takes crab and shrimp shell waste, and they have a non-toxic process for turning it into chitosan. So you're taking something that, there's been millions and millions of pounds, tons around the world of this just discarded for years and years. It was considered, a cost center product for the entire industry. This team came up with a way to turn that into a value add product, went out, and actually very early on we got corporate because we wanted to lock up the feedstock. So we got corporate funders that joined the venture folks that were putting the money in. And they've now completely taken off, used in wastewater, used as a replacement for synthetic nitrogen. And we have this wonderful now sort of closed loop of corporate funding, corporate customers, and should be close to 100 million this year. On track, we think, for 200 million next year. Great company. Second one is called Simplifiber, which I noticed was on your list that was up there. Again, we were first check in there. Venture kind of took it to a certain point, but again, back to the feedstock, Simplifiber takes cellulose waste fibers and through a very, very unique molding process and formula can turn it into just about any product you want. So think of anything that is currently plastic can be replaced now with cellulose on that. Got to our Series A round. We're working with that one and a few others and realized hey, what would be great? Let's get a corporate partner in here that controls a lot of feedstock and has a huge waste cost problem. So Suzana, which is one of the largest, if not the largest, pulp and paper company in the world, came in and led the most recent round for the company. So we're seeing a lot more corporate engagement as they're realizing that things they historically looked at as cost centers or problems can actually be solved by some of these new technologies. And so it's a real win for them.
Great. And Kunal?
I think Sophie and Brock covered most of it, but I think if I can caution founders is, remember, money comes with faces on it. So when you're accepting capital from someone, understand what is the return they're looking for. Why are they taking this bet on you? Sometimes founders take venture capital when venture capital is not the right source of capital for you, right? Sometimes grants or venture debt might be better solutions. Especially now in the market, we've noticed a lot of venture capital is funding a lot of project finance. And that does create tension because project finance risk is not the same as venture capital risk. And so just be mindful of it as to who you approach for that source of capital, because in the long term, it will create tensions in your cap table.
Can we maybe drill into that a little bit further?
Please.
Sophie, if you want to, you can clean up on this and wrap it up. But I think this is one of the most important things that we're observing in the market right now is the number, and I don't want to call it 1.0 because there was lots of stuff that was going on before. So whatever wave you want to call this, that just happened over the last 5 years, the number of companies that were never going to be venture scale that took venture money and are now walking dead is amazing to us. We did a deep dive into the oceans and the whole oceans and maritime sector, tracked 1,000 deals that had come out of accelerators over the last sort of 5 to 6 years. Of those, when we went back through it, we think that there's less than 10, maybe 5, that are potentially fund maker quality deals. Super important. They need to get funded, but so many of them got funded by the wrong source. And once you get on the venture train, it's hard to get off. So I think your point's really 100% right on. If you're a founder and you're thinking about spinning something out here, really be thoughtful about your early capital sources and whether your model ultimately fits the capital that you're taking in, because it can become really problematic.
Yeah. I skipped this slide in the presentation because it's somewhat depressing, but if you look on a company-by-company basis at the velocity between raising rounds, I think there's about half of the previously venture-backed companies that are sitting in market that are stagnant at best, meaning they raised kind of previously at normal or like average velocity of graduating, and then they've just been hanging out. And I don't think anyone wants to hang out for that long without raising some additional form of financing on purpose. Maybe they've become very efficient businesses with AI. Who knows? Maybe I'll be, swallowing my tongue in a little bit. But I think about half the market is in that state of not zombieism, but stagnation.
Yep. Yeah, for sure.
And so that actually reminds me then of your slide about the M&A activity, and it is higher than the previous year, but as you point out, they might have been kind of tuck-in acquisitions, acqui-hires, and just living to fight another day. Kunal, given that you're investing across, multiple strategies, you could say, could you speak to some of the structural challenges that you might be seeing, particularly in M&A and the IPO markets, and kind of what, if anything, could be done right now by the community here that's in the room, and if nothing, but perhaps there is, what are the things that we should consider that we can control to really catalyze and unlock, some of these structural challenges?
Sure. Look, I think we have to understand at the end of the day, investors write you a check because they're expecting to make money back. And there's a lot of dry powder out there in the venture capital in early stages. So relatively for the next few years, it's safe. They've definitely slowed down in terms of allocating capital, but there's a lot of capital out there on the venture side. But LPs are inevitably going to be pressuring GPs for liquidity, right? So if you think about an average IPO in 2000, it took 4 years for a company to go IPO. Today, it takes 12 years. The M&A markets are slow, IPO markets are slow, GPs are going to be stressed for liquidity, and so you have to be mindful of that because over the next 5 years, that $180 billion that was deployed in the past 5 years needs to deliver 3 to 5x. And only 14% of those 3,900 companies funded, I know this because of CTVC, have got an exit or gone public in the past 5 years. And so I expect over the next 5 years, you're going to see a lot of new deal innovation. You're going to see a lot of secondaries. You're going to see a lot of GP continuation funds. And you're probably going to see new innovative structures to sort of help move this path towards liquidity for GPs as well as a lot of startups.
Great. And thinking about these, founders and the challenges that you're facing, this is a question for all of you. How are you thinking about helping these founders navigate this moment, particularly like those really the emotional challenges, the operational challenges? It's really hard. How do you counsel these founders that are out there, or your managers as well?
Rob just picks great companies that exit, so that's easy for him.
I don't know. You want me to go? I'm happy to jump in. I think we've talked, Mike, a little bit about the things. From Sophie said it as well. I think from the very beginning, making sure that there is a compelling business model that can be competitive in the future, and then reinforcing that all the way along. I think one of the things that we do at Stanford Climate Ventures, which I mentioned earlier as well, is the power of discovery these days. I think is still amazingly to me undervalued. And spending way more time, both not just up front, but as you go along, really deeply understanding what problem you're solving and what that's worth to the customer, what the global competitive landscape is. I think at every stage of a company, it helps to remind your founders of that reality because you get sucked into the day-to-day and that's all true, but you kind of forget to step back and go, okay, what are we really trying to do? And more importantly, what do we need to do in order to be a successful company first and foremost, because that will attract capital, and then underneath that, draw the capital to you. That might be too generic, but that's.
I think that's spot on. I think, in the class we teach on entrepreneurship, we constantly focus on mindset, right? Not just mindset of founders, but also allocators. Like GPs are constantly raising new funds, right? And so they, in some ways, when you launch fund 1, fund 2, or fund 3, you're still in a founder mentality because pension funds haven't fully subscribed to you yet, right? And so when you're in that phase, we always caution out about 70% of founders across that category at some point will face mental health issues, right? You start with, okay, you're putting your blood, sweat, and tears into making your wildest dreams into a reality. You're working tirelessly to hope that that creative spark turns into a thriving business. You're betting on the fact that you can work long hours and go through the roller coaster of the highs and lows because you can basically bring to life your idea. But at some point, the stress starts seeping in, right? The nonstop, high stakes, career goal-oriented mindset sort of starts draining you. And when in moments of uncertainty, you start having doubt. Your relationships fray, your physical mental health deteriorates. And what founders usually do in that moment, including GPs, is what they'll do is they'll keep that in because they feel like so many people are counting on them that they can't share that with anyone else and they won't seek help. And I think that's the exact opposite of what they need to be doing in that time, which is getting a coach if they can afford it, getting mentors, basically forming accountability circles with fellow entrepreneurs or co-GPs, identifying patterns in your day-to-day habits that can sort of give you the space for reflection, find an activity outside of work that you're passionate about. Because at the end of the day, you have to stay authentic to your fund or your company, but it's more important for you to stay authentic to yourself because none of that matters if you can't manage yourself in those moments.
Mm-hmm. What about you? You deploy capital.
Thanks. Yeah, I could not agree more with all that's been said, and want to encourage entrepreneurs and fund managers, folks who are working in the industry, the Stanford staff and faculty to really lean in on community. There's this DIY movement, right? Do it yourself. I like to rebrand that, DIT, do it together. Because it does take all hands on deck, and it's a lonely journey. I had been a founder previously, and it's extremely lonely when you're trying to raise that next round of financing or you're worried about runway and you're not going to be able to make payroll. So being able to pick up the phone, go for a walk with a friend. So I encourage you to meet others at this event today because we're all brought together by a common mission and cause. And so with that, I would actually love to transition to the community here and open it up to questions.
How do you unlock capital from other sources like institutional investors? Like I work with CalPERS, it's a pension fund, and they too invest in climate tech. So, because I think we've been focused all on VCs. So do you consider other sources of institutional capital?
Can I just clarify the question? So when you say CalPERS to invest, what are they investing in? In a fund, in a direct, in an infrastructure project?
It's about 15% of their fund. They invest in infrastructure, climate solutions, clean energy. So like infrastructure funds, global infrastructure partners, those type of things.
Yeah. So just from so if you, again, it goes back to understanding the incentive of the allocator, right? CalPERS is there because it exists, it's a pension fund. They have to at some point return capital back to the entire California state pension, right? So they have an obligatory duty towards that, number one. Number two, pension funds in general are more conservative. They're not going to do direct deals. They don't have the ability, the staffing, and the capability. They're not going to do, very unlikely someone like CalPERS is going to do a fund one or fund two. It's possible, they have done it, but it's very unlikely, right? Because they need enough data points to be able to say that they acted in the best interests of their pension members. And lastly, if they do directs, it's usually with a fund because they don't have the ability sometimes to be able to do the diligence required at a venture fund or infrastructure level. And so for any entrepreneur to go get funding from CalPERS is usually trickier. If you're a fund manager, you can start building a relationship with them and hopefully at fund 2 or fund 3 they come in. But that's my advice I would give specifically around any pension fund and especially CalPERS.
And I'd like to build on that. It was actually just yesterday and the day before up in Sacramento, CalPERS and STRS, the state teacher pension, ran a Catalyst Emerging Manager and Diverse Manager conference, where I think you and your colleagues are actively seeking out managers that are deploying capital across all different assets, not just climate or sustainability, but I appreciate the initiative and effort because there's many billions of dollars that's challenging to get out there at scale. But for those capital allocators, investors in the room, to put that on your radar because as you're building and growing your funds and firms, they're an outstanding partner because they're really here and investing for the long term. And also for those interested in this field, I want to just give a shout out to Professor Ashby Monk, who leads the long-term investing lab within the School of Engineering, looking at the objectives, the priorities, the needs, and innovating within these LP asset owners, the long-term capital asset owners.
Just to double click on that, from a DEI perspective, CalPERS has allocated $500 million to GCM and $500 million to TPG to launch funds focused around diversity. So while the rest of the world is pulling back, they've really allocated a lot of capital.
Yeah. Great, we'll have some more questions.
Hi. I would love to double click on the data point on why is it that so many rounds you're seeing a decrease in allocation, but on the Series B round, there's an increase. So we'd love the insights as to why do you think that's happening, especially because many climate tech companies are about or should have been already on the Series B, those that started in 2019 or 2020.
Mm-hmm. Close read of the data. I love it. I looked at that and I don't want that to be a bit of a red herring. The Series B stuff is messed up by there's some enormous Series B deals that kind of throw that chart in particular off. So there are a few billion-dollar Series B companies, or Series B deals rather. I kind of jokingly call it like putting the B in Series B. Like Commonwealth Fusion raised like $1.8 billion Series B round, and that lovingly messes with my data set. I wouldn't look at that as being particularly erroneous. I think it's really, at the end of the day, like the tale of two markets of stuff that's trying to get immediately to exit, which is a broader kind of growth bucket, versus companies that are still proving out, right? And on that hyperscale type of journey, you've got two different high-level markets happening. That said, in real time, there is that compression of the benchmarks, right? That we thought were the benchmarks for like a growth round have now come down, and they're more the benchmarks for like a Series B fundraise. And people in this room should share notes on what are those benchmarks, and to the point of like the community mattering and not the DIY, the do it together types of framing, talking specifically about what have you heard of what's that metric or those metrics that matter the most from folks that are in market talking to investors who are looking to raise, looking to fund the next round, constantly chatting and updating your internal pocketbook of what are the metrics and what are the benchmarks that folks are holding others to. I think that's the strongest set of data for founders out there that are looking to kind of bridge that. So anyway, I don't think Series B is actually doing anything particularly different. It's just caught in the middle between the early stage and the growth stages of the market, and different companies will act funny kind of in there.
Mike, I'd follow up on that just real briefly, take it a slightly different direction. I don't know what you two think about this, but I don't know how many of you actually have read the Wednesday release of the new tax bill and the implications that has for foundations and everything. We are talking about internally a little bit about some genuine fear about Series B, C, D funds. I mean, those funds typically are relying on foundations and others to be, they're going to raise large funds. They need large dollars. If we see these tax rates go up significantly on these foundations and others, this will play out over a long period, over the next 5 to 7 years, but that theoretically are dollars that could be moving away from the later stage funds, which need those kinds of large funders to be part of them. And you've taken endowment money, you know how that works, right? But if those endowments suddenly, their tax situation changes, that actually has impact here. And it almost puts more pressure on the founder to be an outperforming company, because if there's less dollars, essentially the funnel will get narrowed. So if you haven't called your congressman yet, please do. This is important for the climate sector and for anybody that's out trying to invest money behind these things.
Thank you. So I think we have time for one more question.
Yeah, big fan of CTVC, so thanks for coming out today. So one question is, how do you think kind of the end of ZERP has affected climate VC's view of mitigation versus adaptation and share? Like, one argument as an answer to the capital question is, if the world's on fire, sell fire insurance, and I don't need to be willing to pay for a green premium to want fire insurance. Yeah. So yeah, I just wanted to get your thoughts on that.
Nice. I've been thinking about this a lot, walking around campus and chatting with people for the last couple of days, and I know that your fund is specifically focused in this area, and you've done well, kind of taking a position here. So we are not. We're foolish if we think that we're operating in a 1.5 degree world. And that sucks to say out loud, right? And it's important that, like, on campuses like this, that we're paying attention to the scientists who come up on stage at events like this and say, no, we're actually locked into closer to 3+. And Clean Tech 1.0, much of climate tech and much of the slides that we were looking at, I think was premised on this idea of like global collaboration and 1.5 degrees and we'll all work together towards mitigation. And it's not popular and maybe it's not even productive to kind of like say it out loud, but I think there's a bit more of a climate realism that we have to click into. And yet, we can't afford to not, right? Do the efficiency plays, which are kind of more Clean Tech 1.0, do more with less. We can't afford to stop doing the mitigation plays, which is much of the dollars deployed that we just looked at. And I think we got to do even more. And maybe these are like not even climate dollars. Maybe this is some other category. I don't know. Like, do you consider yourself a climate investor? Like you're so-so.
That's a great
like
question.
Future climate investor. Yeah. I think there's this very important emerging bucket and framing of what do we do in a world that's weirder, wackier, more volatile, wetter, drier. I don't know. It's just a funky space and it's more dynamic. And in dynamism, there's a ton of risk, but also if you think about, up and down curves, there's also a lot of opportunity, hypothetically, to ride the top of that. And so Planeteer is super focused increasingly in that area. If you guys have a great idea for how to brand that or what to call it, I haven't quite figured that word out yet. I don't know. It's not quite adaptation. It's not quite resiliency. It's some version of dynamism. I'm thinking a lot about that space. So thank you for calling that out. And I hope that we write more and talk more about that emerging climate realism bucket in the near future.
And I'd love to build on that and maybe even recast it in a slightly different way. This is all about urgency and speed and scale, right? This conference is all about scaling, but I also want to make sure we don't lose the speed aspect. And so with all this urgency that's out there, with all the dangerous and pressing problems, is just what led us to launch this fund, Dangerous Ventures, where we are a climate tech fund, but we also really view ourselves as a resilience and adaptation fund. And really beginning with, if we can be more resilient, sometimes do more with less, not to lose sight of efficiency. I think that's an extremely important component, but it's the yes and, right? It's everything, everywhere, all at once. But business models that really do make sense, ideally today already, but if not, you have a clear line of sight for that techno-economic analysis to really make sense. And not just make sense today with that model today, but to Brock's point, you gotta skate to where the puck is going. You need to project where costs are going. And so perhaps the call to action for everyone out here in this audience and beyond is continue to adapt, evolve, think about how this landscape is changing. How do you respond to the moment and beyond? So with that, I'd love to thank this panel. Please join me in congratulating a wonderful talk.